In this episode from Macro Horizons, Lyngen and Ben Jeffery discuss the bearish breakout in Treasury yields and whether 4.30% 10s represents the extent of the weakness, or if there is more to come. They also consider the outcomes from President Trump's upcoming nomination for the next Fed chair. Let's dive in.
Welcome to Markets Plus, where leading experts from across BMO discuss factors shaping the markets, economy, industry sectors, and much more. Visit bmocm.com/Markets Plus for more episodes.
This is Macro Horizons, episode 358. Patience at the Fed, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of January 26th. On Wednesday, the FOMC is expected to leave rates steady for the first time since July, despite calls from the White House for further cuts, reminding us that the more things are unchanged, the more they remain the same. In the holiday-shortened week just passed, the U.S. Treasury market finally saw a breakout of the range. We had been tracking a very tight range in 10-year yields between 4.10 and 4.20. The sell-off, led by JGBs, motivated a repricing that brought 10-year yields up to 4.3%. Overall, still within the cycle's range, and nothing that would get us concerned that we're overdue for a wholesale repricing above 4.50 or even 4.75. Instead, what we suspect will emerge is an ongoing consolidation, especially given all of the cross-currents on the macro front. The market spent Tuesday and Wednesday awaiting a decision from the Supreme Court regarding tariffs, and the fact that we have yet to hear anything from the Supreme Court on the issue and the court's schedule implies that the next opportunity for insight will probably be the last week of February. So, as the current tariff structure remains in place, there's a great deal of focus on Trump's ambitions towards annexing Greenland. In Trump's Davos comments, he emphasized that he did not intend to use force and was building the case for Greenland to come to the table for negotiations. Now, ultimately, we are very skeptical that this latest endeavor will in fact go much further than has already been the case, but in envisioning the market ramifications for some type of compromise or end of the debate, it would, in all likelihood, be supportive for the Treasury market and, if anything, be an incremental flattening impulse. That being said, our bias in the near term remains towards higher, longer-dated yields, if for no other reason than the strong seasonal implications, as well as the fact that corporate issuance is likely to pick up once the FOMC announcement has been made. There's also the lingering uncertainty regarding who will be named the next Fed chair. It didn't happen at Davos, which implies that an announcement in the week ahead is very much in keeping with the Fed's messaging that the announcement will come sometime in late January. That being said, as the White House has routinely demonstrated, schedules and priorities can quickly change. The price action thus far in January has netted to a bear steepener, but again, the market has been contained as a theme, particularly in the 2-year sector, which remains at least in the orbit of 355 and has led the curve to largely be a directional trade, implying that any further backup in rates will continue to be a steepener. We're closely tracking the range of 73 to 75 basis points in 2s 10s with an acknowledgement that a breakout to a sustainably higher plateau will meet clear resistance in this range.
Well, after Friday's price action that saw the range break for no particular reason other than Trump's acknowledgement that Kevin Hassett was good where he is, aka will probably not be the next Fed chair, we did finally get the break of the range. 10-year yields moved higher above the 420 level that we had been anticipating would ultimately give way. And last week, Treasuries went into the holiday weekend firmly on the back foot. That price action was then exaggerated by headlines out of Tokyo over the weekend surrounding tax cuts, with what that implies for the finance ministry's need to issue more JGBs, and what we saw was an impressive, and by impressive I mean 30 basis point, sell-off in long-end JGBs that had bearish implications across global fixed income markets. Treasuries, gilts, boons all started Tuesday's session meaningfully cheaper, in combination with Trump's rhetoric on the potential for another round of tariffs surrounding his Greenland ambitions, and we now have yields back to multi-month highs. Now, in this context, multi-month highs means 10s at 430, not 450, and indeed, between the flows we've seen and the conversations we've had, the real money community is generally seeing this back up as a buying opportunity. Part of it is the fact that the Sell America trade was never going to be as pronounced or severe the second time around versus what took place in last April, and even though there were some headlines around smaller Danish pensions divesting from treasuries entirely, it seems to be the general consensus that there is some value in U.S. yields at these levels.
Returning to the conversation about the Fed, the week ahead does contain the January 28th FOMC meeting. No one is really expecting the Fed to break any new ground. Policy rates will be unchanged, and the conversation about a potential rate cut in March is likely to be downplayed in favor of stability and concerns that a fresh round of tariffs could once again trigger reflationary fears in the U.S. In considering who will replace Powell, the four candidates had been Hassett, Warsh, Waller, and Reeder. It now sounds like the shortlist has come down to Warsh and Reeder, both of which will argue are strong candidates, neither of which is perceived to have outsized loyalty to Trump. Keeping in mind that every Fed chair is nominated by a sitting president at some point, so there's always likely to be some degree of implied loyalty. In considering the market's response to Warsh versus Reeder, we'll argue that the markets perceive Warsh's experience at the Fed already and his track record as being not as dovish as Hassett, for example, should represent a stabilizing voice on the FOMC. Moreover, given the fact that he has already been a Fed governor, the perception is that he's familiar with the process of building consensus in this particular setting. This isn't to suggest that Reeder wouldn't necessarily have the same capacity, but it's simply more of an unknown, as Rick Reeder represents more of the business side of markets. So, at the end of the day, we're anticipating a relatively limited response in outright yield terms, and if anything, it's more about the passing of an event risk than anything else.
And remember, we have heard from Reeder on some of his views around the transmission of monetary policy through to the actual economy. Clearly, his experience in the private sector and the fixed income market specifically make him more than qualified, and frankly, the fact that he's not quote-unquote a Fed insider probably enhances his appeal, at least to a degree, from the president's perspective. If we're breaking it down between Warsh and Reeder, which from a betting market's point of view are the two frontrunners at the moment, it's less about what either candidate means for the outright level of rates. I think pricing out of the most dovish outcome in Hassett last week means that the outright yield reaction is probably going to be relatively subdued regardless of who ultimately gets the nod, but it's going to be more a function of curve shape, given the previously offered opinions by Reeder in his views that it's not really overnight lending rates that ultimately drives economic activity. For that, we need to look further out the curve at the 10-year sector, and specifically what the level of 10-year yields means for mortgage rates in the real estate market. This lines up especially well with what we've heard from Secretary Bessent and obviously President Trump's desire to get long-end yields and mortgage rates lower, and so it's not unrealistic to think that a Reeder Fed, while maybe the same as a Warsh Fed from a level of Fed funds perspective, might be willing to take a more active approach in bringing long-end yields and mortgage rates lower. Now, what form might this take? Operation Twist is the easy example that comes to mind. It's probably unlikely someone with Reeder's experience would advocate for a QE program at this stage, given what that would mean for inflation. But at minimum, our baseline assumption is that Rick Reeder as Fed chair would have bigger implications for the long end of the curve than Kevin Warsh would.
And there's an argument to be made if the incoming Fed chair makes a concerted effort to control the longer end of the curve by pushing down 10 and 30-year rates, and that translates into lower mortgage borrowing costs, that it will still be stimulative and it risks being inflationary. Perhaps not as inflationary as dropping Fed funds back to the lower bound, but given the fact that so much of the run-up in core inflation over the course of 2022 to 2024 was largely driven by OER and rent, a fresh round of home price appreciation could also contribute to higher rents and higher shelter costs overall, a fact that would complicate the Fed's job, perhaps not in 2026, but in 2027 and beyond.
And that begs the question about how the Fed would react to upside inflation risks that were driven solely by the housing market. Obviously, real estate appreciation is not going to take place in a vacuum, but if in fact we continue to see goods disinflation and the labor market remains healthy-ish, with the core, no pun intended, driver of inflation home prices, given the policies of the White House, with Fannie and Freddie now buying mortgages, potentially the Treasury Department with issuance tweaks in pursuit of lower long-end yields, and maybe the Federal Reserve under new leadership, it's going to be a challenging argument for whoever ultimately ends up the chair to make, and that the forward path of Fed funds needs to be rethought because of housing inflation, but housing inflation is a function of precisely the policies that the Fed is pursuing. It's a communications conundrum to be sure, but it certainly fits with Trump's desire to continue running the economy hot, even if that suggests it's going to be even longer until we get back to 2% core inflation.
And running the economy hot is very consistent with the upward pressure that we've seen on break-evens, as well as the steepening of the yield curve. In the immediate wake of the sell-off in JGBs, we saw a swift re-steepening of the 2s-10s curve in the U.S. back above 70 basis points. Now, we do think it will be challenging to get 2s-10s sustainably above 75 basis points without a decided shift in the macro narrative, if for no other reason than from a technical perspective and the way the trade carries at the moment. Even with this backdrop, we struggle to see a stop-out driven move comparable to what we saw during the first full trading week of January. This implies a trend toward consolidation in 2s-10s, if not slightly steeper, until we eventually get Trump's decision on who will replace Powell. Then, as you point out, Ben, it will be a function of whether or not the incoming Fed chair is viewed as more focused on longer-dated rates or simply content to follow through with rate cuts in the front end of the curve.
And in the near term, that will ultimately be a function of how the building sense of optimism around the trajectory of hiring ultimately flows through, or doesn't, to the realized data. It wasn't so long ago that recessionary concerns were driven principally by the fact that we had started to see some material signs of slowing in the labor market, but now to look at things like JOLTS, to look at things like the NFIB survey, ISM services come to mind, and even NFP itself, there's increasingly the case to be made that maybe all is not lost in terms of the trajectory of hiring or the inevitability of a spike in the unemployment rate. Now, to listen to the Fed rhetoric we've gotten recently, clearly the risks are still pronounced enough, and especially under new Fed leadership, the risks will remain pronounced enough to keep an easing bias intact. Clearly, a January rate cut isn't happening, but March is still very much a live meeting, and given the Fed's de-emphasis on inflation, the near-term trajectory of overnight rates is ultimately going to be a function of the two payrolls prints we get between now and the March meeting.
So at essence, what we're saying is a delayed Fed cut is not a forgotten Fed cut. In the week ahead, the major focus for Treasury market participants will be the FOMC decision on Wednesday afternoon. Here, we're expecting the Fed will keep rates on hold, and while there might be a dissent or two, the clear messaging from Powell will be that there's a balance of risks facing the U.S. economy, especially given the recent rhetoric regarding European tariffs and the general sense that Trump is willing to revisit the trade war in the near term. Now, it is striking to us that the initial impression in 2025 was that the trade war would lead to accelerating inflationary pressures, when in fact what we actually saw was uncertainty that damaged the employment market. Fast forward to 2026, Trump's focus on Greenland and its strategic implications for the U.S. has once again introduced a fair amount of uncertainty for the global economy. The wild card is whether or not that's going to extend the period of uncertainty on the hiring front, or if Q1 will be characterized by a reacceleration of job creation. As it currently stands, the employment proxies imply a solid start to January, and investors will await the February 6th release of the official BLS data for the month. Powell's press conference on Wednesday will similarly be in focus, and any indication that the Fed has a predisposition toward the March 18th meeting will be a tradable event, Although, given the Fed's recent messaging and the fact that there's a clear balance between the hawks and the doves at the moment, we anticipate that the biggest takeaway from the press conference will be one of data dependence and waiting to see how the real economy evolves. The other major unknown is if and when Trump will announce his nomination for Powell's replacement. As discussed, the field continues to narrow, and the week ahead provides ideal timing. On the supply front, because of the timing of the FOMC, Monday sees $69 billion 2 years, Tuesday sees $70 billion 5 years, and then we'll see $44 billion 7 years on Thursday, all of which we expect to be reasonably well received, although supply considerations remain top of mind, especially given the situation with JGBs and its parallel, if not outright similarities, to what was seen in the gilt market not that long ago. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. With the latest winter's deep freeze at hand, we're anxiously awaiting the weather forecasting skills of Punxsutawney Phil on Monday, February 2nd. Perhaps there's a groundhog focused on U.S. rates and whether there will be a Fed cut in the next 6 weeks. We should probably head to western Pennsylvania, just in case.
Thanks for listening. You can follow this podcast on Apple Podcasts, Spotify, or your favorite podcast app. For more episodes, visit bmocm.com/marketsplus.
The views expressed here are those of the participants and may not necessarily represent those of BMO Capital Markets, its affiliates, or subsidiaries.
For BMO disclosures, please visit bmocm.com/podcast/disclaimer.
For full legal disclosure, visit bmocm.com/macrohorizons/legal.